When you picture the beating heart of the AI revolution, your mind probably jumps straight to, microscopic silicon architectures or slick hyperscale server farms.
Right, or like those minimalist Silicon Valley campuses.
Exactly. You probably aren't visualizing thousands of miles of 42-inch steel pipe buried under the dirt of West Texas.
Yeah, or the deafening roar of gas turbine compressors. But if you look at the source material we are examining today, that heavy industrial reality is actually where the future of computing is being forged.
It really is. Welcome to the Deep Dive, everyone. For this one, we are digging into the Q2 2026 earnings call transcript for Kinder Morgan.
Yeah, one of the absolutely largest energy infrastructure companies in North America.
And as always on Talk Tickers, we are looking at this specifically for you, the retail investor. We want to take these executive remarks, the Wall Street Q&A, and the financial metrics and figure out what is actually going on.
Right, because by decoding this specific call, we can clearly see this fundamental rewiring of the U.S. economy.
A rewiring that's being driven by this massive collision between natural gas, liquefied natural gas exports, and the insatiable power demands of AI data centers.
What's fascinating here is the sheer contrast between the digital and the physical in these documents.
Oh, absolutely.
Because, tech companies operate in the realm of milliseconds and lines of code, right? But suddenly, they are entirely dependent on a sector that measures progress in decades.
Decades, permits, and welded steel.
Exactly. Kinder Morgan is essentially the toll collector on the interstate highway system of American energy.
I love that analogy.
Yeah, and if that pipeline network doesn't expand, the entire digital economy faces a pretty catastrophic bottleneck. So the financial metrics from this quarter aren't just, a signal of a company executing well.
Right. They are a leading indicator of an energy grid being pushed to its absolute physical limit.
Absolutely.
And that structural pressure is so evident the moment you look at the headline numbers. So let's start there, getting into the data.
Let's do it.
In the second quarter of 2026, Kinder Morgan reported net income of $867 million.
Which is a 21% jump from the same period last year, by the way.
Huge jump. And their adjusted EBITDA reached $2.199 billion, up 12%.
Right.
Plus, adjusted earnings per share rose 32% to 37 cents.
And for retail investors tracking this stock, moving the needle by 21% on net income for a business of this sheer scale is incredible.
We're talking about a company with over 80,000 miles of pipeline. It requires immense structural tailwinds to move that fast.
It requires broad-based growth across nearly every single segment of their operations. But the context provided by their executive chairman, Richard Kinder, is what frames these numbers properly.
Yeah, he really leaned into their reputation on the call.
He did. He explicitly called Kinder Morgan an unexcited company.
Which is such a funny phrase to use on an earnings call.
Right, because, the market often chases the wild volatility of software or consumer tech. But he pointed out that over its 29-year history, this supposedly unexcited infrastructure firm has compounded its enterprise value at a 22% annual rate.
A 22% compound annual growth rate for nearly 3 decades.
And they've paid out over $40 billion in dividends along the way.
Sustaining that in a heavily regulated, capital-intensive industry is just, it's a financial anomaly.
It really is. And that kind of sustained yield naturally draws conservative investors, which makes the management's forward-looking statements so compelling to dissect.
Right, the guidance. Let's talk about the guidance because they did raise their full year 2026 projections.
They did, yeah.
They are projecting to beat their original $8.6 billion EBITDA budget by at least 5%. Right. And their $1.36 EPS budget by more than 12%.
So what does this all mean for someone looking at the stock right now?
Well, I have to push back a little here. A 5% bump in full-year guidance feels oddly muted when you look at the 12 to 32% outperformance they just delivered in the first half of the year.
That's a very fair point.
Right. If they generated $3.45 billion in operating cash flow in just 6 months, projecting only a 5% beat for the entire year suggests they are modeling a significant slowdown, or at least baking in a massive buffer for the third and fourth quarters.
Yeah, and you aren't the only one who noticed that. Wall Street analysts zeroed in on that exact discrepancy during the Q&A.
Oh, they definitely did.
Yeah, Keith Stanley from Wolfe Research challenged the CFO, David Michaels, on why the second half outlook wasn't more aggressive given the current momentum.
And how did Michaels justify the conservatism?
Well, he provided a necessary reality check regarding the mechanics of their first half outperformance. The first quarter of 2026 was characterized by severe winter storms.
Okay, so weather played a big part.
Massive. When temperatures plummet, wellheads in regions like the Permian and Bakken literally physically freeze.
Wow. Okay.
Yeah, shutting in supply, just as heating demand spikes across the country, that creates extreme price dislocations across the network.
And Kinder Morgan, with its massive storage and transport capacity, capitalizes heavily on those spreads.
Exactly. So they are acknowledging that a localized freeze-off is a windfall, but not a repeatable business strategy.
Right, you can't budget for a blizzard.
You really can. And you also can't budget for global geopolitical crises, which drove the second major component of their outperformance.
Right, the Middle East tensions.
Yeah. Michelle's pointed to favorable commodity pricing across multiple assets, driven significantly by tensions involving Iran.
Because when geopolitical risk premiums inflate the price of crude oil, it disproportionately benefits KMI's secondary segments.
Exactly, like their CO2-enhanced oil recovery business, which we will definitely get into later.
Okay, so management is essentially categorizing a portion of their first half profit as non-recurring.
Right. They're trying to strip out the noise of weather and war to project a normalized run rate for the back half of the year.
I mean, I see the logic in discounting weather events, but CEO Kim Dang offered a counter perspective that kind of challenges her own CFO's conservatism.
She did, and it was a really interesting moment on the call.
Yeah, she pointed out that while you cannot predict a specific storm, the North American energy system is operating with so little slack right now that any minor disruption triggers outsized volatility.
And that is a critical distinction for the retail investor to understand. The volatility isn't the anomaly anymore, it is the new baseline.
Right. If the pipeline network is running at 99% capacity, a single compressor station failure or a brief temperature dip creates immediate localized shortages.
Volatility generated by a lack of infrastructure capacity is structural, not cyclical.
So for the listener analyzing this space, this explains why the physical constraints of the grid are translating directly into outsized cash generation for the operators.
The system is so tight that the value of existing pipe in the ground skyrockets.
And that massive cash generation is radically altering Kinder Morgan's balance sheet.
Oh, completely. It's giving them a level of financial flexibility that forces a rethink of their entire capital allocation strategy.
Let's unpack the mechanics of that balance sheet, because the math here is fascinating and super actionable.
It really is. They ended the quarter with a net debt to adjusted EBITDA ratio of 3.6x.
Okay, 3.6x. And how does that compare to their targets?
It is significantly below their budgeted 3.8x and well under their long-term target of 4.0x.
Which is wild. In an environment where the cost of capital has been a massive headwind for heavy industry, they are effectively deleveraging.
But, and this is the key part, they aren't doing it by paying down debt.
Right. They are growing the denominator of that ratio so rapidly through EBITDA expansion that the ratio just shrinks organically.
It is the absolute ideal scenario for a capital-intensive business.
For sure. Because midstream energy companies traditionally rely heavily on debt markets to fund these massive multi-year construction projects.
Exactly. But because KMI's operating cash flow is so incredibly robust right now, they are organically funding their own expansion.
They even absorbed a $500 million acquisition of a company called Monument during the first half of the year, right?
They did.
Yeah.
And they funded it entirely through internal cash and still ended up under their leverage budget.
That is just a massive flex. It's like putting a massive addition on your house, paying for it in cash, but because you got such a huge raise at work, your debt to income ratio actually went down.
That is a perfect analogy, and Kim Dang quantified what that balance sheet strength actually means in practice.
What did she say?
She stated that simply moving their leverage back up to their 4.0x target would instantly unlock $3.4 billion of incremental capacity for growth projects.
$3.4 billion of immediately deployable capital.
Yes, capital that doesn't require issuing new equity or straining their credit rating.
And the existence of that $3.4 billion buffer prompted one of the most revealing exchanges of the entire earnings call, I think.
Oh, you're talking about the CapEx question.
Yes. Praneeth Sachis from Wells Fargo asked a question that strikes at the core of Kinder Morgan's historical operating philosophy.
Right, because traditionally, KMI caps its growth capital expenditures at around $3 billion per year.
To remain free cash flow neutral after paying their dividend.
Exactly. But Satish asked if, given the unprecedented demand signals from the AI sector, management should consider doubling that CapEx limit to $6 billion a year.
Pushing for a 100% increase in capital spending from a notoriously conservative management team is a massive provocation.
It really is. Wall Street usually punishes companies for abandoning free cash flow targets to chase growth.
So the fact that an analyst is actively suggesting they double their spend tells you everything you need to know about the scale of the demand coming down the pipe.
And Kim Deng's response was incredibly measured. She completely avoided any panic about capital constraints.
She explained the financial physics of their model. Right?
Yeah, she laid it out clearly. As they deploy capital into new projects, those projects come online and generate immediate EBITDA.
Which organically pulls the leverage ratio back down over the life of the asset.
Right. Because of this self-correcting mechanism, she made it clear they have the firepower to execute a much higher spend model if the market demands it.
So the constraint is no longer access to capital.
Not at all. The constraint is the physical ability to build fast enough to meet two colossal macroeconomic forces.
LNG exports and data center power demand.
Exactly. The demand twin engines.
Let's dive into those macro trends, because Wood Mackenzie's projections, which were cited repeatedly on the call frame, the sheer size of this demand.
The numbers are frankly hard to wrap your head around.
They are. Wood Mac is forecasting U.S. natural gas demand to exceed 160 billion cubic feet per day by 2035.
160 BCF a day.
Which represents a 46 billion cubic feet per day increase from 2025 levels.
If we connect this to the bigger picture, we need to put a single BCF into perspective.
Yeah, what does 1 billion cubic feet actually translate to?
1 BCF is enough energy to power roughly 10,000 average American homes for a year.
Okay, wow.
So we are looking at adding the equivalent energy consumption of 460,000 homes to the grid every single day for the next decade.
The physical reality of moving an additional 46 BCF per day is just staggering.
It is. I mean, Kinder Morgan's entire network transported just under 48,000 BB2s per day this quarter, which is roughly 48 BCF.
And that was a 7% increase year over year.
Right. So to accommodate the Wood Mackenzie projection, the industry essentially has to build an entirely new Kinder Morgan from scratch over the next 10 years.
Which is insane to think about.
Yeah.
And the first driver of this is liquefied natural gas.
Right, LNG.
The U.S. is cementing its role as the global swing producer, cooling gas to negative 260 degrees Fahrenheit to condense it into a liquid and loading it onto specialized tankers bound for Europe and Asia.
But the second driver, the one upending all historical models, is the AI data center boom.
Yeah, and the call highlighted a very tangible example of this collision.
The Georgia deal.
Exactly.
Yeah.
The recent agreement between Southern Company and OpenAI to construct a massive AI data center in Effingham, Georgia.
Which is huge because it transitions the AI power narrative from theoretical white papers into signed commercial contracts.
But this brings up a massive structural question, and I want to push on this for our listeners. Tech companies have spent the last decade marketing their commitment to 100% renewable energy, right?
Oh, yeah. Buying up solar farms and wind projects left and right.
So why is an AI data center in Georgia suddenly driving localized demand for natural gas? Why can't a hyperscaler just build a massive solar array to power their servers?
It's a great question, and the limitation lies in the fundamental architecture of the electrical grid, specifically the concepts of baseload and dispatchability.
Okay, break that down for us in plain language.
Sure. So solar and wind are intermittent resources. They generate power when the environment dictates, when the sun is shining or the wind is blowing, not when the consumer demands it. A traditional data center can occasionally manage minor fluctuations, but an AI data center is different. One that is continuously training large language models with billions of parameters across thousands of interconnected GPUs. It cannot tolerate a microsecond of power interruption.
They require absolute 2047 reliability.
Because a drop in voltage doesn't just dim the lights.
It cascades through the server racks and corrupts the training run.
Exactly, wiping out millions of dollars of compute time in an instant.
So they need a rock-solid baseload.
Precisely. And until grid-scale battery technology advances to a point where it can store gigawatts of power for weeks at a time, which, by the way, we are nowhere near achieving physically or economically, intermittent renewables just cannot serve as the primary power source for these facilities.
They require dispatchable thermal generation so that you can turn on and scale up on demand.
Right. So when a tech company signs a 1 gigawatt power purchase agreement with a utility like Southern Company, that utility is forced to build or secure a new natural gas combined cycle power plant just to guarantee the reliability of that contract.
Even if the tech company is buying renewable energy credits, to offset their carbon footprint on paper.
Exactly. The financial accounting might say green, but the physical electrons keeping the servers alive at 2:00 a.m. on a windless night are generated by burning natural gas.
That distinction between the financial accounting of carbon credits and the physical reality of grid engineering is the core thesis of KMI's future.
It really is. If you are interacting with ChatGPT or relying on enterprise cloud architecture, your compute cycles are inextricably linked to the combustion of natural gas.
And to feed those newly constructed power plants, Kinder Morgan has to build physical pipelines. Which brings us to their project backlog.
The backlog is where the future revenue is hiding.
Yes, and it's currently segregated into two distinct buckets, the sanctioned backlog and the shadow backlog.
Right, so the sanctioned backlog currently sits at $9.6 billion.
Now, this figure actually decreased slightly from the $10.1 billion reported in the previous quarter. Is that a bad sign?
Not at all. That reduction represents successful execution, not lost business.
Okay, let's unpack this.
Yeah, they placed $650 million worth of heavy infrastructure into service.
Right, projects like the Cumberland Pipeline in Tennessee.
And the Highland Express in the Williston Basin.
Plus the GCX expansion in Texas.
Exactly. These have moved from the construction phase to the operational phase, meaning they are now actively flowing gas and generating real revenue.
Furthermore, they have $400 million in projects that are contingently approved, awaiting final signatures to be officially added to the active ledger.
But the sanctioned projects are just the tip of the spear. Management spent significant time detailing a shadow backlog of over $10 billion in highly probable opportunities.
With 92% of those being natural gas projects, right?
Yep, 92%. And the transition from the shadow backlog to the sanctioned backlog requires a deep understanding of how midstream companies eliminate risk.
Because they definitely don't operate on the build it and they will come philosophy.
Absolutely not. The mechanism that moves a multi-billion-dollar idea into active construction is called a final investment decision, or FID.
A huge term in the industry.
Very huge. A project languishes in the shadow backlog while KMI negotiates with producers, utilities, and LNG operators.
And before Kinder Morgan commits a single dollar of shareholder capital to steel and labor, they secure long-term take-or-pay contracts.
Those contracts are the secret sauce. They dictate that the customer must pay a fixed reservation fee for the capacity on the pipeline, regardless of whether they actually flow gas through it or not.
And these are usually 15 to 20-year contracts, right?
Yes. They are completely insulating themselves from commodity price fluctuations. Whether natural gas is trading at $2 or $8, Kinder Morgan collects the toll.
They aren't taking energy market risk. They are taking counterparty credit risk, which is why they demand investment-grade customers.
Exactly. And that structural insulation is what allows them to command such impressive financial returns on these sanctioned projects.
Which leads right into the multiples. Management highlighted that the remaining $8.5 billion of non-CO2 and non-gathering projects in their backlog carry a projected 5.6x EBITDA multiple.
And for the retail investor, a 5.6x multiple on heavy regulated infrastructure is staggering.
Okay, let's unpack this for someone who might not live in the spreadsheet all day.
Sure. Building a $1 billion pipeline at a 5.6x multiple means that asset will throw off approximately $178 million in pure operational cash flow every single year.
Wow.
Yeah, it equates to an unlevered return on capital approaching 18%. On a piece of steel that will likely remain operational and highly valuable for half a century.
That is just incredible cash generation.
Yeah.
And during the earnings call, analysts actively tried to pin management down on the timeline for converting that $10 billion shadow backlog into these high-return FIDs.
Oh, they were very pushy about the timeline.
And the executive team indicated they expect to announce at least another $1 billion in formalized projects in the second half of 2026 alone.
The most remarkable aspect of this dynamic is that despite migrating billions of dollars into active construction over the past year, the total value of the shadow backlog refuses to shrink.
It's like a hydra.
Exactly. The funnel of inbound demand from data centers and LNG terminals is replenishing the opportunity set faster than the company's engineering teams can draft the blueprints.
So to understand where this unprecedented capital is actually flowing, we have to look at the physical geography of the pipeline network.
Right, you have to look at the map.
The earnings call highlighted severe localized bottlenecks, particularly in the Haynesville, the Permian Basin, and the Southeast.
And each region tells a distinctly different story about the mechanics of the U.S. energy grid.
Let's start in the Haynesville Shale, situated across East Texas and Northwest Louisiana.
The Haynesville is experiencing volume growth that stretches the limits of existing infrastructure.
Kinder Morgan reported that gathering volumes on their Kinderhawk system surged by 54% year over year.
54%. And to manage this tidal wave of molecules, CEO Kim Dang discussed a $500 million investment currently being completed to add 1 billion cubic feet per day of treating capacity.
Now, treating capacity is a vital nuance there.
Very vital.
The gas coming out of the ground isn't ready for a pipeline or an LNG terminal. It has to be scrubbed of impurities like carbon dioxide and hydrogen sulfide through amine treating facilities.
Right. They are investing $500 million just to clean the gas before it can even be transported.
And the Haynesville's explosive growth is purely a function of geography, right?
Yeah, it sits incredibly close to the U.S. Gulf Coast, positioning it as the most efficient direct supply source for the massive LNG export terminals coming online.
But while the Haynesville is booming because of its proximity to the coast, the Permian Basin in West Texas is facing a completely different, almost paradoxical set of challenges.
The Permian is wild. It's the most prolific oil field in the world, and that actually creates a massive logistical headache for natural gas markets.
Oh, so?
Well, in the Permian, drillers are targeting lucrative crude oil. That's what makes the money. However, when you extract that oil, a massive amount of what they call associated gas comes out of the wellhead as a byproduct.
Which is just natural gas that happens to be trapped with the oil.
Exactly. But the producers view this gas almost as industrial waste. They simply need to dispose of it so they can keep pumping the high-margin oil.
And this dynamic creates one of the most fascinating market anomalies in the global economy.
The Waha spread.
Yes. The Waha hub is the main pricing point for natural gas in West Texas.
Because drillers are producing far more associated gas than the existing pipelines can physically carry away, and because environmental regulations strictly limit how much gas they are legally allowed to flare or burn off into the atmosphere, the local price of gas completely detaches from the national market.
Here's where it gets really interesting. It creates scenarios where the price of natural gas at the Waha hub drops below zero.
Right, below zero.
The producers will literally pay operators like Kinder Morgan to take the gas away.
It's mind-blowing, but the negative pricing is simply an operational cost they absorb to avoid shutting down their multi-million-dollar oil wells.
And this desperation was palpable in the Q2 results.
Oh, absolutely. When Kinder Morgan finished their $450 million GCX expansion project, which added 570 million cubic feet a day of takeaway capacity out of the Permian, the new pipeline capacity filled up instantaneously.
The producers were lined up at the valve before it even opened.
They really were.
But patching the current bottleneck isn't enough. KMI is planning for the next decade of Permian growth with a project called Permian Link, which targets a 2030 in-service date.
And this project is a masterclass in strategic infrastructure planning.
Seidel Modi, the president of Natural Gas Pipelines, explained that Permian Link isn't just another tube aimed at the Gulf Coast.
No, it is specifically designed to route through major underground storage facilities, providing a buffer against volatility.
Furthermore, the routing of Permian Link highlights an emerging trend in heavy infrastructure development.
Yeah, management noted they are building the pipeline footprint parallel to a newly approved 765 kilovolt electrical transmission line overseen by ERCOT, the Texas grid operator.
By co-locating a massive high-voltage transmission line and a high-capacity natural gas pipeline along the same geographic right-of-way, they are establishing a symbiotic energy corridor.
The regulatory friction, land acquisition, and environmental reviews are streamlined by combining the footprint.
And the resulting corridor provides the dual physical inputs, heavy wire and heavy pipe required to support the gigawatt-scale data centers migrating to Texas.
It's just brilliant planning.
We see that same utility-scale demand fundamentally altering the landscape in the Southeast, too.
Right. We discussed the OpenAI facility in Georgia, but the macro utility forecasts for the region are staggering.
Georgia Power recently projected 75 gigawatts of new demand by the mid-2030s.
75 gigawatts.
To supply the power generation required for that load, KMI is aggressively expanding its footprint. They are pushing Project 219 South on the Tennessee gas pipeline to route massive volumes for the Appalachian Northeast down into the southern states.
They're also navigating the complex regulatory process for two massive regional projects.
The $1.7 billion Mississippi Crossing, or MSX project, aiming for a 2028 launch.
And the South System Expansion 4, a $3.5 billion joint venture where KMI holds a $1.8 billion share.
Management noted they're expecting certification from the Federal Energy Regulatory Commission, or FERC, imminently.
And you have to remember the NEPA environmental reviews, the stakeholder engagements, and the right-of-way acquisitions for projects of this scale take years of upfront capital before a single piece of pipe is ever laid.
Natural gas is clearly the primary growth engine, heavily fueled by LNG and data centers. However, Kinder Morgan operates a highly diversified asset base, and their earnings call revealed some surprising friction and unexpected windfalls in their other fluid segments.
Yeah, the narrative wasn't universally positive across the board.
In their product pipeline segment, refined product volumes like gasoline, diesel, and jet fuel fell by 5%.
Which management pointed to supply disruptions on the West Coast and a generally high commodity price environment that slightly compressed consumer demand.
Now, a 5% dip in refined products is a cyclical fluctuation, but analysts immediately questioned a much larger drop in another metric.
Ah, the crude drop.
Yes, KMI reported that crude and condensate transport volumes plummeted by 16%, down to 421,000 barrels per day.
And a double-digit decline in crude takeaway from a massive midstream operator usually signals severe operational distress or producers actively abandoning the system for competitors.
Right. If I'm a retail investor holding this stock, a 16% drop sounds catastrophic on the surface. If they're losing that much volume, isn't that a huge red flag?
It would be. But Dax Sanders, the president of the company, provided the vital context that completely neutralizes the panic.
What was the real story?
The decline was an intentional, highly calculated strategic pivot. They deliberately took a major piece of infrastructure, the Double H pipeline, offline.
So they aren't losing market share?
No, they are converting the asset from carrying crude oil to carrying natural gas liquids, or NGLs.
Okay, the conversion of the Double H pipeline illustrates how dynamically midstream companies manage their steel.
NGLs components like ethane, propane, and butane are essential chemical feedstocks for the global petrochemical industry.
They are the building blocks for plastics, fertilizers, and synthetics.
Exactly. And the margin for transporting NGLs out of producing basins to the massive fractionators on the Gulf Coast has become significantly more lucrative than standard crude transport.
By taking the pipe out of service, cleaning it, reconfiguring the pumping stations, and changing the tariffs, KMI is upgrading the asset to a higher-yielding market.
And if you mathematically exclude the volumes lost to that deliberate conversion, their underlying crude transport only declined by a modest 5%.
So panic averted.
Definitely.
Meanwhile, their terminal liquids business is operating at peak efficiency. They reported that overall lease capacity for their massive storage tanks is sitting at an incredibly high 93%.
And in critical logistical hubs like the Houston Ship Channel, tank utilization is at 99%.
They are effectively sold out of real estate for liquid storage. But the most unexpected outperformer of the quarter came from their CO2 segment.
Right. The CO2 segment is often really misunderstood by the broader market.
People hear CO2 and assume it is some green tech carbon capture initiative.
Exactly. But in reality, it is a highly specialized legacy oil extraction business. Net oil production in this segment actually jumped 10%.
Driven heavily by a 15% surge in output at the Sexo Roche unit in West Texas, a field that has been producing oil since the 1950s.
To understand why a pipeline company is pumping oil, we have to look at the mechanics of enhanced oil recovery, or EOR.
Let's unpack that jargon. How does EOR work?
Well, when a traditional oil well is depleted, massive amounts of crude are still trapped in the microscopic pores of the rock, unable to be extracted by conventional pressure.
Right.
Kinder Morgan owns vast reserves of naturally occurring carbon dioxide in places like Colorado. They pipe this CO2 hundreds of miles down to West Texas and inject it under immense pressure deep into these legacy fields.
And the physics of this EOR process are fascinating.
They really are. Under high pressure and temperature, the CO2 reaches a supercritical state where it acts as a miscible solvent.
It literally washes the stubborn, trapped oil out of the rock formation, swelling it and pushing it toward the producing wellbore.
And because global oil prices remain elevated throughout the quarter, buoyed by the geopolitical tensions in the Middle East we discussed earlier, the margins on this heavily engineered extraction process widened significantly,
driving a surprise beat for the entire corporate entity.
Yeah, it was a huge windfall.
Now, while the CO2 segment relies on legacy fossil extraction, The earnings call did feature a small but potent metric pointing toward the energy transition.
Right. KMI noted an 8% increase in renewable natural gas, or RNG, volumes.
And they attributed the bump to localized operational improvements.
RNG involves capturing methane emissions from biological sources, like massive municipal landfills or industrial dairy farms, and running it through complex amine treating facilities to upgrade it to pipeline quality specification.
It is a nascent, highly fragmented market compared to their core operations.
True, but the 8% growth indicates that KMI is actively building the operational muscle to process and transport alternative molecules,
Ensuring their pipeline network remains relevant regardless of the pace of the green transition.
Exactly.
So the financial results, the massive backlog, and the structural demand drivers paint a picture of a company executing flawlessly.
Mostly flawlessly.
However, the Q&A session with Wall Street analysts exposed the severe physical and regulatory friction that KMI must navigate. The constraints on their growth are no longer financial. They are deeply logistical.
And the most immediate example discussed was the Western Gateway project.
The Western Gateway project is a major proposed joint venture with Phillips 66.
Right, but despite intense market demand, Dax Sanders had to inform analysts that the final investment decision has been delayed by 1 to 2 months.
And the rationale he provided was entirely structural, citing the, quote, complexity of the proposed arrangement.
It is a stark reminder that heavy infrastructure development is as much a legal and bureaucratic process as it is an engineering challenge.
Before any dirt is moved, massive corporations have to align on joint venture governance, liability allocation, capital call structures, and regulatory compliance.
The paperwork bottlenecks are proving to be just as formidable as the physical bottlenecks.
And that bureaucratic friction extends aggressively into their maritime operations, too.
Right, because KMI owns a significant fleet of specialized tanker ships used to move refined products between domestic ports.
During the call, analysts pressed management on the impact of the Jones Act.
The Jones Act is a foundational piece of U.S. maritime law, passed way back in 1920.
And it requires that any goods transported by water between two U.S. ports must be carried on ships that are constructed in the U.S., owned by U.S. citizens, and crewed by U.S. citizens.
Because American shipbuilding is exceptionally expensive compared to international yards, the total supply of Jones Act compliant tankers is highly constrained.
This artificial scarcity grants operators like Kinder Morgan immense pricing power when leasing their fleet.
Exactly. But the vulnerability arises when the federal government issues temporary waivers to the Jones Act.
Which they often do during localized energy crises, like a hurricane knocking out a colonial pipeline.
Right, allowing cheaper foreign flagged vessels to temporarily operate between U.S. ports.
And these waivers instantly inject new supply into a closed market, immediately threatening KMI's lease rates.
But management remained incredibly calm about it, assuring analysts that their domestic fleet is 100% leased through 2026 and 80% leased through 2028.
Effectively insulating them from short-term waiver volatility.
Yep.
But the most systemic and troubling bottleneck discussed during the entire hour was buried in a question about global supply chains.
Oh, the turbine question.
Yes. An analyst from Bank of America drilled down into the availability of gas turbines and compression equipment.
Which is critical because a pipeline isn't just a hollow tube.
Right. It requires massive compressor stations placed at regular intervals to maintain the immense pressure required to push billions of cubic feet of gas across a continent.
And the machinery required for this is highly specialized. We are talking about aeroderivative gas turbines.
Essentially the same jet engines used on commercial aircraft, re-engineered to spin massive centrifugal compressors instead of fan blades.
The metallurgy required for the turbine blades, the precision machining, and the complex control systems can only be manufactured by a handful of companies globally, like GE or Siemens.
And the analyst pointed out that because utility companies are frantically ordering these same turbines to build new power plants for AI data centers, the queue at the manufacturers is stretching into years.
It's the ultimate physical choke point. You can secure the land, get the FERC permits, and have billions of dollars in cash ready to deploy. But if you cannot take delivery of a turbine, the pipeline cannot operate.
Yet, Kim Dang's response to this severe supply chain constraint was remarkably unfazed.
She noted that KMI recognized this bottleneck forming over 2 years ago.
They didn't attempt to fight the constraint. They adapted to it by radically altering their project timelines.
For massive developments like the MSX project, they are securing board approval and placing equipment orders 36 to 48 months in advance of the targeted in-service date.
They are baking the friction directly into their economic models.
When you synthesize all of these intricate dynamics, the century-old maritime laws, the bureaucratic weight of joint venture agreements, and the multi-year manufacturing backlog for specialized metallurgy, you realize something profound.
What's that?
Energy prices aren't just dictated by supply and demand on a trading floor. They are dictated by the agonizing friction of the physical world.
And that friction is exactly why Kinder Morgan's existing network is generating such massive returns. The barrier to entry for a competitor to replicate this system is virtually insurmountable.
They possess a $3.4 billion balance sheet advantage, a highly strategic $10 billion shadow backlog, and the engineering expertise to navigate a supply chain that is buckling under the weight of the AI revolution.
For the retail investor, the bottom line is clear. They are not merely participating in the next era of the U.S. economy, they are physically welding its foundation.
Which forces a radical reevaluation of how we categorize these industries altogether.
It does. For the past 15 years, the prevailing economic narrative has championed technology companies as asset-light, agile innovators.
Right. They operated in the ephemeral cloud, untethered from the physical constraints of heavy industry.
But as we track the billions of dollars KMI is deploying specifically to feed the gigawatt scale requirements of these server farms, that narrative just collapses.
The cloud is rapidly becoming the heaviest industry on the planet. It requires monumental volumes of steel, concrete, and uninterrupted combustion to function.
The data centers may house the intelligence, but the intelligence cannot survive without the baseload power generation,
which cannot survive without the physical delivery of the fuel.
This dynamic leaves us with a profound final thought to ponder. If the world's most advanced artificial intelligence is entirely dependent on the continuous flow of natural gas through legacy infrastructure, who truly controls the future of the digital economy?
Is it the software developers in Silicon Valley writing the algorithms, or is it the midstream energy companies controlling the literal switch to the power grid?
The most sophisticated technological advancements in human history are completely tethered to an industry that pulls hydrocarbons out of the dirt. Thank you for joining us on this deep dive into the source material. We hope this exploration helps you look past the headlines and understand the hidden physical mechanics driving the digital world. Keep questioning the systems around you, and we'll catch you on the next deep dive.